Macro news is the new reality TV. You see this reflected in the rise of prediction markets. The result would be that people would want to be cross-asset by default. If you're tracking inflation, you might have started out as, an equities trader, but you're probably going to develop a view on currency devaluation and gold and Bitcoin and all sorts of assets that span asset classes.
This material is for informational purposes only and is not intended to provide accounting, legal, or tax advice, or investment recommendations, or an official statement of Presto or its affiliates.
Hi guys, welcome to Presto Research Podcast. In this episode, I'm joined by Rick, my colleague, and also Kaledora from Ostium. Hi, Kaledora. Could you walk us through your background and also what Ostium is?
Sure. Just so, maybe briefly on background, my co-founder, Marco, and I met in college at Harvard freshman fall in an intro econ class. It was a macro econ class. Both had probably too many takes on the market and eventually figured we should become friends rather than raising our hands incessantly in the broader classroom. So that was sort of the genesis story of our friendship and ultimately of the company. Before that, I have a bit of a unusual background. My first career was as a professional ballerina, so I danced professionally with Royal Danish Ballet in Denmark for a number of years. Retired and went back to school, and that's sort of where the Ostium genesis story starts. Worked briefly at a couple hedge funds over the summer, as did Marco, mostly on the macro side. So that's our background. In terms of the story of Ostium, so maybe I'll just take a step back and sort of walk through the sort of broader vision or what prompted us to come up with the idea and start building in the first place. And we were talking about this before, but about the sort of broader macro environment and the thesis that we developed there. Look, so most high level, we developed a conviction that the first sort of generation of trading platforms or like consumer facing trading platforms evolved during a period of time, sort of post Great Financial Crisis, pre-COVID, that was characterized by very low inflation, very low interest rates, and I would say a relatively stable geopolitical climate, all things considered. And the sort of first evolution was very much focused on single asset classes. So a Coinbase focused on crypto, a Robinhood largely focused on stocks, generally focused on single asset classes. And that was largely because they were catering to the trader base and the behavior that was most common on the trader side at the time, very much focused on single asset classes. We think that COVID fundamentally changed something in the markets and sort of broke the sort of general dynamics. And there was a very important downstream effect, or that there would be a very important downstream effect. So we sort of developed this broader thesis right in the aftermath of COVID while still in college, that sort of the next 10 to 15 years in the markets, very sort of broadly speaking, very broad strokes, would be characterized by macro, whether that's more volatile interest rates or more unpredictable sort of behavior from various central banks, or persistently higher inflation not actually just being purely transitory, it had been initially speculated, or just general more geopolitical uncertainty, that all of this would result in sort of the macro environment having both being more volatile and as a result more interesting to follow. I've said like macro news is the new reality TV, and I think you see this reflected in the rise of prediction markets and and similar products. But also that the result would be that people would want to be cross asset, and that there would be cross asset by default, because if you're tracking inflation, you might have started out as an equities trader, but you're probably going to develop a view on currency devaluation and gold and Bitcoin and all sorts of assets that span asset classes. And so we thought that the first generation of retail trading platforms, and I'm talking broadly like Web 2, Web 3, just writ large, I'm going sort of very, very broad on the thesis here to begin with, would be, the first generation trading platforms would focused on like these, like largely catering to people who are trading a single asset class and weren't really going to hop around. And you see this reflected not only in terms of availability, but also in terms of the instrument that's used. Maybe you're on Robinhood, you're on a broker, and you can trade option. You can trade stocks with some amount of leverage through options. But if you do want to trade commodities, you now have to figure out how to trade futures. You're learning there's new friction points, new hoops you have to jump through, new instruments you have to figure out how to use. So they're natural friction points. It's not purely just availability. It's also the format under which the assets are offered or you can trade them. And we thought that sort of the next evolution of these sorts of platforms would be cross asset by default, and as a result, single instrument by default, that they would be easier to trade across everything from metals to energy to FX to crypto, stocks, indices, even things like, yields, maybe volatility indices, all sorts of different instruments all sorts of different assets across a single platform with a single instrument in a transparent and sort of legible way. So that was sort of the original like super high level thesis. We got there in a bit of a winding way. Initially, like, I've talked about this a few times, but like our first rabbit hole that we went down on the crypto side, and I guess we never really emerged from it, was reading up on, synthetics and mirror and some of the early attempts at, I guess, non-tokenization means of like bringing traditional assets on chain. Yeah, I won't maybe go too deep into that, but we broadly developed like as far as like architecture and structure and how you might be able to accommodate and bring those assets on chain. We became quite convinced that the market would sort of go in one of two directions, neither of which were aligned with sort of the initial or like early attempts at bringing, say, gold on chain. We thought one would be the tokenization route. So basically taking like the Circle or the Tether, like stablecoin model, let's say, and applying it broadly. I'm oversimplifying here, but broadly applying it to other assets. I think Pax Gold is like a good example of this. They hold the underlying asset, it's custodied, you mint to redeem it. There's like a token that represents it that people can freely trade and is composable. But it is backed by the underlying, which ensures that broadly, like, there's a minting redemption process that people can participate in and arb out any sort of like mispricing, or that there would be or that the other approach would be sort of like a trading first approach, which would focus on perps or sort of a perp adjacent instrument. The early attempts like were kind of taking the DAI model and trying to apply it to other assets, and you saw this with some of the attempts, these like kind of CDP attempts. So you back it purely by on-chain collateral, you mint it. The problem is it's super capital inefficient. You kind of unfortunately get like the worst of both worlds. You get neither like the benefits of actually holding the underlying in a proper way through a tokenized asset, and that you would, like, in theory, if done correctly on a stock, let's say, you would get like governance rights, or you would be able to, you get dividends and so forth. So you get neither that if you do it that way, nor do you get the flexibility, the leverage, the ability to short easily, et cetera, that you would get with a perp. So the kind of the market, we thought, this was back in like 2022. We thought the market was going to diverge in like in these two different directions. We didn't think we had any kind of edge on doing things on the tokenization side. And we thought like larger institutions were probably going to be going to win that market. And regardless, we thought it was much more exciting and interesting to try to approach it from like a trading first perspective. I also thought there was a unique opportunity if you could actually, do it effectively, if you could actually build these assets out as perps, or you could build perps on these assets, you would have a wedge into this like broader sort of consumer trading market that we thought had not caught up, going back to sort of the original sort of thesis that I described, as well as a fair bit of research and hands-on experience that we had trading on some sketchy, let's say, offshore brokers, which I can talk more about. So we thought there was a unique opportunity there in doing this through perps, and more exciting and better aligned with sort of what we thought was undervalued in the market and the market was going to need. So that's the long answer to your question of like how we got here. I'll pause there.
Yeah, thank you. Then my first question might be a little bit repetitive, but it's on the appetite that you mentioned behind the super high level thesis. So in your core thesis on your website, and as you just mentioned, you've highlighted the fact that we're in this like post-COVID, post like zero interest rate policy macro regime, and retail traders are more and more macro aware, like trading around inflation prints and Fed decisions and being aware of commodity prices in general. And I also definitely see that like reality TV shift that you were saying amongst my not traditionally macro interested crypto friends. Like there was a period where maybe it was last year when everyone on CT was suddenly like a macro expert as well. And at the same time, capital is increasingly staying on chain via stablecoins and tokenized assets. So this intersection of like TradFi or macro sophistication and crypto rails that's the wedge I think you mentioned Ostium is positioning itself in. So what's driving this new appetite for like on-chain macro, like the macro aspect specifically? Is it a continuation of crypto traders expanding into different asset classes, or is it traditional like non-crypto retail traders migrating into or within the crypto infrastructure?
Yeah, it's a great question. So to answer your question, the first, I'll answer it in a sort of sequential way. So there's the market that we're going after today, where we've seen the most demand to date. which is definitely driven by crypto natives. So these are, a paint more specific picture. These are largely people who have a significant proportion of their net worth on chain. They made their money in any of the last, let's say, 3 cycles. They typically last, let's say, last 2. They don't really want to off ramp this sort of large amount of capital that they have on chain. I think many of us can relate to this. Probably many of the people listening. You make you make money on chain, and you kind of you don't want to off ramp as much as you wind up having, or if any, or very little, either because they don't want to trade on a centralized broker that they don't trust. They got burned on one of the collapses. They don't like the UX. They're used to the flexibility they have in crypto. I think an under-discussed problem also is for a lot of people where a significant proportion of their net worth is on chain, they don't often get taken seriously by traditional institutions. They might want, you might expect you might be at a level where you should be getting private banking, or you should be getting some very flexible account access, but you aren't granted that because the sort of what you can attest to as far as your assets that would perhaps qualify you is largely on chain, and maybe that isn't taken seriously or counted by traditional institutions. There's all sorts of different reasons why people don't want to off ramp, but what we found is precisely as we mentioned. This macro news is in reality TV. People are tracking these macro events, and certainly they develop an opinion on them, on sort of their impacts on the broader markets. And interestingly, just one more comment maybe on the prediction markets is we've since sunset it, but not without revealing too much, that will at some soon no longer be the case. But we had rolled out something right on top of the core product that we called Strategies back in October last year, which was built using polymarket odds as sort of a trade trigger. So very simply, you can think of it as a conditional order in the same way that a limit order is a conditional order based on price, or TWAP would be sort of a little bit oversimplifying, but an order that gets triggered conditional based on some time having elapsed. Here you can think of it as a conditional order that gets triggered based on the probability of some event. And so we had people basically coming in and being able to put on trades if the Trump odds are higher than 70% long Bitcoin. And so a lot of people put on those sorts of trades in the weeks leading up to the election, they got triggered the night of. So I mention this because we actually found that a lot of people not only wanted to trade the outcome of the market directly, which certainly there was demand for, but many wanted to actually trade not just the outcome of that market. And unfortunately, many of these markets are the liquidity is pretty fragmented. They're very nascent markets. They're going to get a lot better, but they're still you're going to face quite a bit of slippage if you want to put in a massive position on yes or no on some market. And we found that actually often what people want to trade is not the event. They want to trade the downstream effect of the event. So exactly in the description that I gave, right? In the example that I gave, if Trump wins, then I want to long BTC. Or if the war in Ukraine is ended, or there's a peace agreement, then I want to long the euro, or maybe then I want to short oil, whatever it is. People are taking in these events, and they're tracking them, and they want to trade on the downstream effects of them on these broader and much more liquid markets, because ultimately you can move way more size betting on Bitcoin or betting on oil than you could on just betting on the market for whatever the resolution is going to be to the war in the East. We saw this sort of broader trend of people wanting to track these markets and then downstream want to express a view on them. And we saw this happening in our initial thesis was this would happen, and I think it's really proven itself out. Sort of a fractal way, maybe is a sort of oversimplification, but that would happen in Web 2 for traditional traders, that they would move from not being just focused on a single asset class. And you see this revealed by kind of even survey data, and you ask people 30 years ago, what's the optimal construction of a portfolio, and 60-40 stock bond portfolio was kind of a classic answer. You ask anybody under the age of 40 and it's less than 10 or 20% say yes. So, and you even want to see these fractionalized VC products, fractionalized PE products, investing in fine wine. There's all sorts of quirky sort of long tail. So people are investing cross asset. They are investing based on these broader macro theses. And we thought that would happen among Web 2 totally non-crypto native traders, and among crypto native traders as well. And so where we've really found initial product market fit and our entry in sort of our beachhead market, I I would say, has certainly been crypto natives to date. So these people, as I described, who made their capital on chain, have a significant proportion of their net worth on chain, don't want to move it off chain for any of the various reasons and plenty more that I described, but want to express their view on these very liquid markets, global markets. They don't want to just do it directly. Maybe they do that sometimes, but just through expressing a view on a prediction market, on a specific outcome, they want to bet on the broader thesis associated with that outcome. And they don't really have a good place to do it. And we're the only place they can do that in size. There are now the market has gotten much more competitive over the last 6 months, which I always say is a great thing. It means it's a huge market. It means our thesis on the size of the market is being validated, and it makes everybody sharper. But all of the other approaches have largely been sort of order book based. So trying to recreate native liquidity from scratch on chain. I'm sure we'll talk more about that, so I won't go into too much depth, but they've all been order book based rather than actually trying to go and fetch the most liquid, the market, the price from the most liquid market, which is what we do. And so as a result, we're really the only place that people can express those views on these assets on chain directly in size, not sort of without the, massive slippage or massive price impact or, running through the books or like very, very volatile funding rates or something like that. So that's where like our initial PMF and demand has come from. But obviously the much larger TAM, and I think you can I think we can 5 to 10x or something from here within that market, even just with like the simple tailwinds over the coming months or quarters, let's say, from this market. But I think the really, really big TAM, going to 100x, 1000x from where we are today, requires expanding into this traditional market and actually converting traders on these traditional brokers to use an on-chain platform. And I'll talk more about that after, but I think my answer to your question has been long enough.
I think you already answered my next question in a sense, so I'll phrase it a little differently. So I think Ostium kind of fits into this broad category of perp dexes in these days, but it seems like what you're focusing on is more than just being a perp dex. But given the space is increasingly being competitive, and especially since when you started a long time ago, how do you see your product to differentiate from other competing products in a simple way? I think you already might have answered this question, so maybe you can talk about how your vision might have evolved since the beginning, or maybe it's the same. Then you can just talk about that as well.
Yeah, I mean, the vision has definitely evolved in specifics, but we've been we've iterated a ton on implementation, sort of the broader go-to-market strategy. I mean, obviously, we've been building for a little bit, but I would say the vision has actually remained stubbornly, if you look back at my posts from 2021, 2022, the vision has remained stubbornly consistent. And I think the market has started to catch up, which is very validating. But yeah, in terms of your question on what's our differentiation, how are we, different? The single most important answer to that question is the liquidity model and how we've implemented our own architecture vis-a-vis the approach that I think some of the perhaps the newcomers, or new entrants into the scene that are trying to go after this market or building a similar product have adopted. And I'll start sort of first by describing what is the model and then why we chose it. So it's a quote-based liquidity model that nets against a pool. It is not an order book, and there are very specific reasons for this. So we started with a basic conviction that the market structure in a given market was sort of going to be path dependent, or that the optimal market structure would be contingent or would be influenced by what the existing alternatives are, right? So if you look at, I'll take the example of a Hyperliquid or any of the on-chain order books, they are competing with a Binance. That was sort of the first. They're competing with Binance or Bybit or any of the existing sort of big centralized exchanges in crypto. And that's a very tall order to try to compete with their liquidity and sort of be able to match them, that you can have people, move real size and have deep liquidity on these crypto assets. And many have failed in that endeavor until I think very recently, only over the last, year with, the advent of Hyperliquid, you've seen a formidable competitor that actually is matching, in some cases exceeding the liquidity of those centralized exchanges. But that, while a tall order, is a very different story than trying to compete with, say, the CME or, with ICE and any of its subsidiary exchanges, let's say, with NYSE. These are highly consolidated, very, very liquid markets. And if you want to quote Tesla, let's say, You are trying to compete with the quotes on the deepest, the most liquid exchanges in the world, and which are far, far, far more liquid than something like, an ETH market on name any of the centralized exchanges. Um, and so the bar for how liquid your offerings need to be in order to be competitive with the market, that underlying exchange, is much, much higher. And you also have to take into account like who the players are that would allow you to get there, right? If you're trying to build like an order book for any of these, crypto assets on chain, you need to convince like the same set of players that are market making on the centralized exchanges to go and market make on you, and they're crypto native market making firms. So that's like, it's taken some time to get all of them comfortable with like market making on an on-chain system and on an on-chain order book. But they've broadly like it's a more solvable problem. In the other instance, if you were trying to go and compete directly with NYSE or with NASDAQ, let's say, you need to compete. You would need to have all of the largest market makers in the world that are the vast majority of which like, maybe don't have a crypto arm, or if they do, it's entirely segregated. It doesn't interface with their sort of traditional market arm that's like, market making on name your market, to go and be market making on, your perp dex, if you want to get even close to competing with that liquidity. And in our view, I'm not saying I'm not trying to be, a poo-poo curmudgeon and say, that's like we're not eventually going to get there, right? Like I definitely think I wouldn't be building crypto if I didn't think all markets in some form would eventually move on chain. But I think if what you're trying to service or you're trying to offer, the problem you're trying to solve today is enabling like a great trading experience with deep liquidity on chain on traditional markets like gold today, the solution is not to try to like, go and compete with the underlying gold market, which is just, as I think hopefully makes sense, like is a very, very, very tall order that I think will take a very long time. Your solution is actually to quote the most liquid market and then to have a system to dynamically manage that risk or hedge with whatever, party you need to hedge with, and be able to actually just quote that market and offer that price up, or the closest thing you can offer to that price, to users on chain. So you can think of it as more, and like just taking a step back, like, we've long held the principle of like, let's try to look at what has worked in traditional markets, like try to learn from, you don't need to reinvent the wheel on certain things. You should reinvent the wheel where it matters, but not unnecessarily. You should look at what has worked. And there's a very good reason why the primary means through which consumers around the world access, US markets, or sort of generally, a market like gold, or let's just say Tesla in this example, is through these basically synthetic, brokers in Web 2 that offer synthetic pricing or offer synthetic exposure and pricing to traders around the world. They are not interfacing directly with an exchange. Like they're not plugging. If you're a trader in, the Vietnam or whatever it is, you can't go and make an account and own like a US stock in the US, on the US market. You have to go through an intermediary that is going to quote you that price and actually enable you to get exposure. But you're not, it would be absurd, right? If like there were many exchanges popping up, like thousands of exchanges popping up around the world for, new markets on Tesla or new markets on gold. No, like different platforms that people want access, they'll go through a platform and it routes and pulls in pricing and exposure from, or pulls in pricing from the most liquid market. So we've kind of taken a similar approach, and I can talk more about the architecture, but the really important, like the most important difference to answer your question, like how are we different, is we are not trying to recreate that liquidity on chain today. We go and we quote the most liquid market, and as a result are able to offer much, much deeper liquidity, much better execution, and ultimately much more predictable fees and sort of like holding costs for our users due to that architecture choice.
Okay, then maybe we can talk more about that infrastructure you mentioned. And you also said like, this is one of those questions I ask not because I believe it, but basically all finance coming on chain, like that's in the future at some point. And so crypto, I guess, becoming the execution layer of finance, which I agree. And to an extent, I feel like if you don't agree, what are you doing in this industry kind of thing. It's a very core thing. But why does all of this have to be on chain, for example? So in like the Vietnam retail trader, like if there was a platform that could non-crypto or non-blockchain based platform that could offer a lot of products to a lot of people in the future with with the lack of friction that exists today, and it's not on chain, does that solve all the problems, or is there still more reasons beyond that why these things need to be on chain and why people will benefit from this on chain infrastructure?
So I love this question. And the answer is it definitely needs to be on chain. And the market we are going after and that we're going to disrupt is one of the most notoriously opaque and predatory parts of traditional finance. And generally, I think hopefully this is a non-controversial view, but that DeFi will eat the worst parts of TradFi first. And if you look at how, just to bring up, this consumer in Vietnam again, right? Like how most people around the world get access to these markets, let's say just like US markets in this instance, it is through what are called in sort of the trading. I'm talking on the trading side, less so purely on like the long-term investing side, even though people also access these instruments through or do long-term investing through these instruments, but it's largely catered towards traders. So if you look at how majority of traders around the world access, let's say, the US markets, it is through an instrument called a contract for difference, and sort of colloquially termed CFDs. CFDs are offered by, I would say, largely opaque centralized brokers, where your counterparty is the broker's pool of capital themselves. They internalize a majority of the flow, but none of that is revealed to the user. They don't have any way of knowing what is internalized and what isn't. And then whatever they don't want to internalize, so namely they don't want to take the other side to, they will go and they will hedge with a partner, typically through what's called a liquidity provider. Same name as is common in crypto, which will aggregate basically like requests for hedging from different providers, net it, and then sort of they manage their own risk on the back end and then hedge in the underlying or with another partner. So, why do I mention this market? It's a huge market. Most people are unaware of it's not a very sexy market at all. It's actually very unsexy, quite the opposite. Not often discussed, but it's a gigantic market. It's hard to get precise just estimates because of how opaque the market is, but something like 10 trillion notional flows through these markets every month. They are the most widely used retail derivative outside of markets like the US and India. And frequently used on things like FX, metals, energy, single name stocks, indices, crypto, you name it. So and it's a very flexible instrument. It's very, very similar to a perp. I think people often, again, sort of a similarity that people are largely unaware of. You can easily long or short. There's a lot of leverage available. It's a synthetic instrument, so you can't redeem it for the underlying. It's a continuous instrument. It's perpetual in its own way. There's no, you don't have to roll over contracts or anything. They handle all of that. All of those things are very similar to perps. The core difference being that perps when you're trading on a perps exchange, you are exposed to the real market dynamics of that perp as an instrument, namely like the perp, the like market index price might deviate. And so there's some, like delta between those two. You're going to have a funding rate that's going to be variable based on like the liquidity dynamics of that exchange. Here on the CFD, those sort of market dynamics are somewhat or largely abstracted. So you don't face like variable holding costs or a variable like entry costs, except for occasionally in sort of a sketchy way, which I'll talk more about in a second, based on the liquidity dynamics of that platform itself. So, but largely it is a similar instrument in many ways. What is the problem with these brokers? Because it sounds in many ways great. You can get access to all of these instruments in one place across assets. Seems largely aligned with the vision that I sort of outlined in the beginning. Seems great. There's a big problem, which is that these brokers are largely complete black boxes, and they are very opaque, and you have very little recourse as a customer. They have full discretion to largely close, and I mean like without naming names, like they'll claim that this is not the case, but if you read their terms of service or, you trade too profitably on any of these, you'll often face this outcome. I think some crypto people, maybe some smaller exchanges, are no stranger to this sort of behavior. Very common, if you go on some of the subreddits for some of these guys, you look for my account was closed. It's often because a lot of suspicion around the accounts being closed because of being too profitable, these sorts of things. And they all have all sorts of tricks basically in the book that they can pull effectively to minimize flow from sort of people who are too profitable or trading too well. They can arbitrarily close your account. They can even withhold your initial deposits. And like, Marco and I experienced this like firsthand when after college, we were like trading on many of these, which is sort of also part of the genesis story that I didn't describe earlier. They can withhold your deposits. So you may have deposited, you're running a strategy that they don't like. They can lock your account and you actually can't pull your money out at all. And again, you don't really have recourse. So, and then another thing actually that's very important to mention is like, it's a very manual process. You wouldn't believe for a lot of these sort of like longer tail brokers that capture a large portion of the market. It's a quite fragmented market, which also makes it a great market to go after. For many of this like long tail of brokers, you would not believe how manual the process is for onboarding. You often have to you have to interface directly with an account manager where you deposit, and it's not enough that you deposited. You have to go and confirm that you deposited manually by, I mean, I've seen examples where like you have to take a screenshot of your attempted deposit and send it to your account manager, on WhatsApp to prove that you actually deposited, and only then will they approve your transfer. I mean, it's insanely manual. And it is so manual because it's not an industry inhabited by tech people. Like, I know that's a pretty broad it's a very broad statement, but I don't actually think it's a very controversial one. Like, most of these brokers are basically like marketing machines. They don't have any of their own tech. It's all outsourced. There's plenty of companies that basically do this sort of like just aggregation. They'll serve you like price feeds, like risk model, bridge to liquidity provider. There's like front end, they'll like package everything in, and you just kind of, plug in, and basically it's just an entity that has some sort of amount of capital, some, license in some niche jurisdiction, and a marketing team and a set of account managers and all of that stuff. And so as a result, like the underlying like liquidity dynamics, the architecture of these, brokers, like the whole industry has basically been, again, I'm oversimplifying, but like has been sort of like at a standstill, or like has not evolved in like a really deep, meaningful way in the last like decade and a half. There's been innovations in the margin, like adding copy trading, like eToro. That was sort of eToro's core insight and things like that. But the broader liquidity architecture and the core problem of these businesses, which is that they have full discretion basically over, like, they control user funds. Obviously can't self-custody. It's highly manual to, onboard. They can withhold all your capital if they want to. It's very opaque. You don't know what's going on the other side. The liquidity is very unpredictable. If it triggers their risk model, they'll just dry up the liquidity in a pair and they won't let you execute a trade. It'll just revert. So if you're running a programmatic strategy in size, it can be very frustrating. None of that stuff has changed in any meaningful way in the last like decade plus. And so we think this is a very opaque and legacy part of TradFi that happens to be this massive market, happens to be used by like tens of millions of consumers around the world, happens to offer all of these different assets, and yet is extremely opaque, hasn't been disrupted, and is largely dominated by legacy players with very little sort of like tech background, largely building out these sort of like marketing machines. And so the answer I'm giving you there is like both like, why does this need to be on chain? Like everything I've described, I think, honestly, it goes without saying, is like a textbook use case for something you'd want to put on chain. Like if you can solve their core problem, which is they're so opaque, they're not transparent, you can't trace anything, nothing is auditable, you don't know like what is the liquidity available up front. If you can solve all of that by basically having like a transparent platform where all of the flows, all the positions are auditable, you can track them at any time, you can solely self-custody your funds, it's instant onboarding and offboarding through instant deposits and withdrawals, on-chain, you're just constrained by block times. This like gets to the very core of sort of what is legacy and what is not working about these businesses, for such a huge market that is, frankly, like is the primary conduit through which like most global participants or like global traders actually like participate in US markets, but just like markets more generally. So textbook use case for crypto, and also in our view is sort of a greenfield market opportunity to go after that we don't see anybody else focusing on. And I'll make my prediction here, like publicly. Give it 3 months. I actually said this before when I was talking about tokenized assets and saying that the conversation was going to shift. Tokenized equities, the conversation was going to shift to perps on equities. Give it 3 months, maybe even less. No one is talking about this market right now in crypto. Everyone will be talking about it a quarter from now. It's a huge market. It's very legacy. It hasn't been disrupted, and all of its problems are solved by, I mean, its core issues are ripe for being addressed by like a blockchain-based platform. So I make that prediction now out in the open. Hopefully you guys can clip it and post it in 3 months.
Yeah, we'll message you in 3 months. But that's interesting because I can't remember what you did, Thomas, on the sell side, but I think it was also opaque, but it worked out. The opacity was okay because there's an element of trust and security that both parties or all parties agree on. But I guess on retail platforms, that trust is not as reliable as it is in like for banks. So without that trust and it's opaque, you run into this issue that you described.
I think the proof is in the pudding. Just one small aside. If you go on an interesting exercise, go on the landing page of many of these brokers. This is like well, again, I don't want to get in trouble and name specific names, but go on the landing page of any these big brokers. One of the first things you see on like the front page, right underneath like the hero or like core description of the website, is almost always a Trustpilot ranking, and that should tell you something. They're all advertising a Trustpilot ranking because their users don't trust them, and for good reason. Again, often because none of these, like, you don't own the underlying asset, which is also not the case in a perp, right? You can't redeem your like BTC perp for Bitcoin. So whatever, that's the case in any of these sort of like most of these derivatives, I guess, besides like futures that might be settled in the underlying itself or whatever. You can't actually access the underlying asset, which fine. But the problem is not only can you not access the underlying, you also have no idea what of your flow is being routed in one direction or another. You have no idea programmatically exactly how much liquidity is available to you. You don't know when it might dry up on an asset because you triggered some model. It's not pre-revealed to you. There's no like, here's the open interest that's available, or like, here's the funding costs can also, or the holding costs, they can sort of arbitrarily change on you. None of that stuff is like written programmatically in like auditable smart contracts. So people don't have, they don't have that trust. And yeah, these are not banks. Like these are, there's a very long tail of like smaller sort of centralized brokers that manage this. And so no, they don't have like the institutional credibility. And frankly, they shouldn't. So
but they have a Trustpilot, so that's all good.
Yeah.
Yeah, so I kind of this kind of leads into our next question, which is so let's talk about the product itself. So I think you mentioned that in order for these online blockchain platforms to win, they need to compete with the existing retail brokerage. So what's your idea of building a legible product for the audience? What's your go-to strategy like?
Okay, great question. Again, many great questions. So when I say legible, and I think this was maybe in like the tweet that went, viral about, funding rates, or it wasn't in there. It was like maybe in my explainer tweet, or I've written about this in some like articles about our architecture choice. By legible, I mean, if you want to go and disrupt that market, people need to be able to understand your product. And there's the obvious, I think, stuff like, can they figure out how to sign in with the wallet? You need to offer them like social sign in. How do they onboard? Blah, 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 blah. Those are all, they sound like simple, but they're very, hard questions. But there's, I think, a more niche question that is equally, if not more important, which is, do they understand the fee structure? And do they understand like the structure of the instrument that you're offering? Because, we're offering a quote-based perp, not an order book perp. So it differs along, core, verticals. But, and as I discussed earlier, like perps are very similar in many ways to these instruments that these sort of like centralized legacy brokers are offering. But they do differ, as they should, right? Otherwise, we're not trying to replicate what they're doing if we think they're doing it poorly. We're actually trying to do something very different and take our own approach. But you need it to be different along the axes that matter and similar along the axes that allow your product to be relatable. If it is only different along every axis, like the market that you're going and trying to disrupt will not recognize your product as within their wheelhouse. They won't recognize the product and they won't know how to use it. And ultimately, it's going to be much, much harder to go and convert them. And so by legible, I mean, I'll focus on, I think, what is the most important aspect, which is the fee structure. Perps, sort of traditional order book perps, have these like variable funding rates that vary based on sort of, the deviation from mark and between market index price. They reset on some regular cadence. And they are highly variable, especially in lower liquidity or more nascent markets, one direction or another. And that can be, in our view, is a major impediment to onboarding users in this sort of like broader market that I described, because they won't recognize the fee structure. So to give you context on like what is typical, or like what are the holding costs typically on these sorts of like brokers that I described, on these legacy brokers, there's different account types. So they'll have things like a raw spread account, which is just giving you the spread coming in from like the ECN market on FX, for instance. They don't, add their own spread on top, but they'll charge you higher fees. They have different account types that will not give you a raw spread. They'll charge a spread on top, but they're a no fee account. So there's some variance in terms of like the fee structure, but writ large, one of the most sort of like common aspects across these platforms is they typically have very predictable and very low holding costs. So on many of them, for instance, you won't even actually face what they call like funding rates a swap fee. That's their term for it. You won't even face a swap fee unless you've held the position longer than 5 days or longer than 10 days or whatever it is, or overnight. So there's a period of time over which you're not charged anything to keep your position open. And then after some threshold or some length of time, then you are charged something. And so this is very different, right, from like, you are charged something, and like what you are charged is typically, some premium above, the Fed funds rate, or like the underlying market, like carry costs. They'll charge kind of like a broker, like an inferred like broker premium on top. These are very low. I mean, except for maybe on asset like, oil, where the like futures curve might be like in like massive backwardation, or like contango, which would like affect sort of the implied like carry costs. Besides on an asset like that, like generally for most of the assets, you're going to see holding costs that are, very close to something like the Fed rate, which is not high, and importantly, not highly variable. And that's very different from what you would expect to see and what you do see on funding rates on markets, again, nascent or, illiquid markets, which obviously any of these TradFi perps are. Obviously, the S&P is not an illiquid market. It's one of the most, like S&P futures are like one of the most liquid markets in the world. But if you're trying to put them on chain as a perp, that is like long tail for crypto. So I'm saying when I say long tail, I mean like, how much liquidity, like where does this sort of stack rank in terms of how much liquidity there exists in the crypto ecosystem, like allocated towards that pair. And I've said this on a few other like pods, but like unfortunately the outcome of like, listing, trying to recreate like order book liquidity on perps on like S&P, on the S&P, is like you have the most liquid market in the world, or one of the most liquid markets in the world, actually trading and exhibiting the like, price wick or funding rate volatility behavior that you would expect on a shitcoin. Like, if you look at Pax Gold, for instance, just as an example, during the whole like October 10th chaos, it wicked down like 25% on the perps on many exchanges. And like the gold market was actually closed, and it's a super gold would never wick down 25%. So it's exhibiting the liquidity dynamics of like a super illiquid shitcoin, but actually is like a $30 trillion market. And that is something that, some crypto natives might be willing to put up with. Although I actually think, it's like we've already seen this with ourselves. Like if you have an alternative where that's not the case, like they're going to stop putting up with it. But they might be willing to tolerate it. But certainly people coming over from like, a centralized like legacy broker, even if it sucks along a lot of dimensions, if they're going to suddenly have their entire account liquidated because like, Tesla wicked down like 50%, they're going to leave and they're going to never come back. And so you need both like, pricing and execution that is not subject to like the liquidity dynamics of crypto and like randomly dries up when crypto liquidity dries up because people want to trade the underlying market. They don't want to trade like the underlying market with like the risk premium of like maybe crypto dumps or something. They want to like just trade the gold market. And then importantly, they also want to have these like fees that are matching or similar in their structure to the market that they're accustomed to. So they don't want to suddenly have a funding rate that's going to like spike up and totally like obliterate their P&L over some short period of time because they're not used to that. And again, crypto people might be willing to tolerate it on like an altcoin that moves 30% in a day, but people are definitely not going to be willing to tolerate that on like gold or euro or S&P or whatever, NASDAQ, you name it. And certainly not like these traditional sort of users. So yeah, hopefully that answers your question.
Yeah, definitely. Because people's holding times of traditional assets are probably way different to crypto native people's like shitcoin holding times. So annualized, maybe. So the annualized, like, I thought the tweet you sent out a few weeks ago, the funding rate is so true. Like that's not something that like people might not even know is a thing they have to face if they're coming into crypto from traditional brokers or if they're institutional. And then again, like you said, they won't tolerate. Which, by the way, I retweeted and I agreed with you. That was a very typical CT. It doesn't matter who's right. It's like it matters who has the microphone, like who has the floor. And then if
your statement that maybe lacks even the tiniest bit, even slightly lacks nuance, can be misinterpreted by a willing party, it will be. So
I would drill down on it as deep as that can go. And yeah, that was a bit unfortunate because there were people who I know knew better, like who went in on it because they're .HLs anyway, because they were like ex TradFi. Okay, so next question. Today, 10th or 11th, or 11th or 12th of November, depending on whether you're in Asia or the US, Bitcoin is up 10 point whatever percent and gold is up 55%. So quite the outperformance of gold over digital gold. And so your early focus on commodities, including gold, feels very well timed. Why did you start with commodities out of all the asset classes that you've mentioned throughout this podcast? Why was commodities an early focus? Was there a personal interest or do you see like a market need there?
Yeah, another good question. So I told some of the early lore of like how Mark and I started the company, but there's probably like another piece of lore worth mentioning. Right before we obviously formally started the company, we were just marinating in the idea maze. This was like 2022 winter. I remember I was like writing my thesis, like my senior thesis. I like locked myself in the library and like didn't look at Twitter for some period of time, and when I like opened it back up, the war in Ukraine had started. And like I think Mark and I were both, he was like writing an essay, I was writing a thesis. We like stayed up looking, like researching all of the downstream implications on commodities that we thought might take place. There was some very crazy behavior in the wheat market. Sort of that area of the world is sort of, they call it the breadbasket of Europe. So there was a huge squeeze on like wheat prices. There was a huge effect on like nat gas. There was, I think it's what I would call is like a weird sort of delta or like gap between like LNG and NG, like the US market. So there was some very weird kind of like dislocations in the commodities markets. There was also like lithium. I remember reading, I went down a really deep rabbit hole on this one, but there was like one lithium refining facility in like southern Ukraine that was processing like 80% of the world's like refining. I'm probably butchering this because it's been a while since I thought about this trade specifically, but there were some very weird sort of long tail commodity market implications that we were tracking, and we found it was very actually like hard, even in the US with like these extremely open financial markets. It was very hard to trade a lot of this stuff. Like you have to go on, you have to trade like a 2x levered ETF that like wasn't necessarily tracking the underlying price like very clearly. You might look at some, companies that were up or downstream in production as sort of like a proxy. But there was no like really good way to bet directly, especially if you were like a small shrimp like we were in college. Like, we weren't like able to open, couldn't exactly build like a diversified portfolio of like with contract sizes that were, in the tens of thousands of dollars. Like, so we found it very hard at Shrimps to like access these like longer tail commodity markets. And more broadly, we had this sort of like thesis that I alluded to in the beginning of this like changing. This was like another indicator. We'd like had this thesis of this like changing macro environment, and I think this was just like another kind of like nail in that coffin. Like things were getting geopolitically much more uncertain. The downstream implications on these like various markets and especially commodity markets were going to be increasingly large in magnitude, in one direction or another. And so I think, so we were, we were like trying to trade these commodities markets, found it pretty hard. Our first sort of very unsophisticated thought was like, wow, it would be like really cool if you could fractionalize these markets and make them like easier to access for somebody that didn't, without having to go and trade like the entire contract size. And you have these like micro contracts on the CME for some of the, for like, gold or like an oil, but not for most of the assets. And you really actually have to have like, you have to be like pretty large to trade them. Unless you're like in a full port your entire portfolio into like wheat or something, which I probably wouldn't suggest. And so that was sort of the first, that was like the first, the germination of like the idea. But more broadly, we had that it played sort of, it dovetailed like really into this like broader macro thesis that I was describing because, on this like macro volatility and uncertainty, geopolitical uncertainty, all of that stuff, it really dovetails this broader thesis on like a commodity super cycle. We were also reading at the time, I think it was like Grantham was like, it had written a letter about, just like the sort of overvaluation in equities, which I guess has only expanded since then. So we were, it's just like never be a bear, I suppose. There were like early whispers about sort of like a commodity super cycle. And I think we just like bought into that we're very strongly aligned with that belief. Also, if you believe in sort of the devaluation thesis and like, which I think is certainly starting to really prove itself out. Bitcoin is one hedge, but gold and, other stores of value are another hedge. So we had this kind of like little constellation of views across like general commodity super cycle, inflation, devaluation, geopolitical uncertainty, impact on supply chains, various long tail commodities that all sort of came together in this like broader commodity super cycle thesis. And so the first white paper that we wrote was basically just like 10 pages of ranting about like gold and commodities more broadly. And like the first half was like why people would be interested, why there would be like a massive increase in demand for sort of like general consumer access to trading commodities. And I'll give like Nick Van Eck of Agora a shout out because he co-led our seed round, or he on the team led our original seed round back in 2023 at General Catalyst. They co-led the seed, and he was the sort of deal partner. And I remember the first call I got on with him. He had read the white paper, and he was like, I typically got on most calls, sort of talking about the broader commodities thesis, and he was like, "You don't need to pitch me. You don't need to tell me anything. I've been, buying gold my entire adult life. I'm fully on the same page. Tell me how it's going to work." So at the time, we were still very sort of like purely commodities focused. Ultimately, we expanded beyond that. We actually thought like commodities was going to be way too niche. And we saw this broader opportunity in the sort of like, what I described this thesis on like cross asset and not just making, one asset class more accessible, but being able to trade across these asset classes with like a single instrument that was simple. We, by that point, had like started trading in a lot of these like shady brokers and been kicked off or had our capital withheld or all sorts of bizarre experiences that led us to believe that there was a massive opportunity in trying to disrupt this sort of legacy market. So putting all those pieces together, we're like, all right, we're not just going to focus on commodities. There's going to be like FX. There's going to be, crypto, equities. There's more opportunity in going sort of like cross asset than just like trying to optimize one specifically. And the instruments and the architecture that we can build to optimize across these assets will, on commodities will apply across assets. So we should leverage that and make it more focused on generally global markets. So that's the direction we went. But we kind of wound up being like more correct than even we anticipated. Like where we've like really just seen insane growth has been in like gold and copper, and like this most recent metals rally in the fall has been nuts and frankly amazing for us. We were really like the only place you could trade like copper, palladium, platinum, silver, gold, like all in one place, with pretty deep liquidity. So yeah, sometimes the market works out in funny ways, but yeah, that was the OG lore and thesis.
Yeah, I kind of forgot how crazy those days were. Like, so you were born in such an interesting period for commodities because 2022, like oil was at over $100, I think, and then only 2 years before that. I mean, we would probably all remember when was it the May, like the K0 May 2020 contract went to -30, whatever. And then when Ukraine stuff started, I had just moved to London a week before the Russian invasion, and then all my friends here who had like variable electricity prices, their electricity went up like 10x, I think, the next month.
That's insane. Yeah.
And we had a locked-in one, thanks to my girlfriend's amazing geopolitical foresight. So we were fine, but that was an actual issue. I forgot how crazy, like every aspect of commodities was interesting then. When the canal was blocked and all that happened, and good times.
Yeah.
Or not good times,
Energy
but
especially was like insane. I mean, the
yeah,
last like quarter, 2 quarters, it's been like metals that have gone crazy. But no, energy was the first to get like just experience insane volatility. And it had like, I think the thing about commodities is like it has a direct impact on your day-to-day life. Like, most people are investing in like the stock market and like whatever, they put money in their IRA. And so the stock market going down matters for them or up, and they, see that. But it is like numbers, on a screen. Whereas like when commodities go crazy, or I mean, even again, niche market, but like eggs, so much of the US election was like, you wouldn't believe the number of like the amount of commentary during the debate or during, any of these, podcasts that each of the candidates did talking about eggs. It was like, we're going to bring down the price of eggs. Eggs are too expensive. Commodity prices have this, people don't say the kind of thing that like people mostly don't think about until like suddenly they like really think about them, and it has like a massive.
Yeah. So this is going to be our last question for this episode. What's the successful end game for Ostium looks like? Is it going to be replacing the institutional brokerage or institutional brokers, or going after retail platform? Which way do you think it is?
I'm gonna say both. I'll start. So I think there's like $100 billion opportunity in like perpetuals on TradFi assets, and like nailing that market genuinely. I think a lot of the new entrants in the market that you're starting to see now, and it's only going to increase in the coming months. I think our initial validation on the size of the market. If you look at perps generally in crypto, they're obviously a gigantic market. They're the dominant sort of retail or consumer derivative, much, much larger than options. I think, it depends on the numbers you look at, but something like 100x larger than the options market, or something close to that. And now if you imagine this market being extended to all traditional assets that are traded through these either highly opaque, often predatory, and centralized and very sort of manual, brokers with around the world, which are sort of the primary way that people access these assets, or on more institutional or more trustworthy sort of brokers, and things like Robinhood or others that are have obviously much more real products with real institutional credibility. You have this like fragmentation problem, and you have this problem of people largely trading options, which are much more complicated to understand. You have to track Greeks. I think just generally just much more complicated for consumers. I think this is starting to become a pretty consensus view that perps are probably a better instrument to trade them, or having to jump through these hoops, as I described. If they want to trade cross asset, they have to, learn how to use different instruments. I think the opportunity in consolidating trading across those different asset classes and assets into this one simple and easy to use instrument both gives you the opportunity to sort of disrupt, or it gives you the opportunity to disrupt sort of like three markets. The first one is in crypto. I think the subset or the category of perps that will be TradFi perps will grow to be larger than the category of crypto perps, or similar in size. Let's say if you're just catering to sort of a crypto audience, because of this broader trend of people wanting to trade cross asset on chain and keeping their money on chain. And right now they're a tiny fraction. So even if you're bearish and you think TradFi perps in crypto are only going to be 10% of the crypto perps market, that's still a very, 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 very large market. Second vertical would be these sort of on these more trusted, broker platforms, but that have this fragmentation across different instruments, and where largely when people are trying to sort of take these directional views on, consumers trying to take these directional views. They're doing it through options, which I think perps are just a better instrument to do so. So that market. And then the third market is the one that I've, been talking about, I think, somewhat extensively on this podcast, which is this very legacy, opaque, sort of centralized like CFD broker market, disrupting that through sort of a decentralized on-chain perpetual instrument that mirrors many of the sort of aspects that traders like of those platforms, but gets rid of the sort of opacity and lack of legibility and all the associated issues. I think those are like three different distinct markets to go after, all of which are, at least I'd argue like at least like a $10 billion opportunity. And I think if you combine them all and across those markets, and some is like greater than the whole is greater than the sum of its parts. I really genuinely believe like this, like it's $100 billion market. So it's a huge market. We want to go after all of those. It has to be in sort of a phased way. I think many startups have died in the valley of trying to go after too many markets simultaneously. So we've tried to do things in like the right sequential way and be thoughtful about how we approach the go-to-market. As I outlined earlier, the initial sort of approach has been focused on crypto natives who don't want to off-ramp their capital and want to trade these assets under this simple format with great liquidity on chain, especially who want to move size. And that's really where we found our initial sort of beachhead market and where we're going to continue, doubling, tripling down on. But the broader market, sort of the next big market that we'll be going after is this, is disrupting this like legacy CFD broker market and solving, sort of getting to the very heart of what the problem is of many of these platforms by disrupting what we think is, yes, one of the most like legacy and in many instances sort of more predatory aspects of the traditional markets. And disrupting that through like a blockchain based solution or a crypto solution that actually makes all of these things like legible and transparent, and much easier to trace, and instant deposits, all of the wonderful features that I described earlier. So that's sort of the broader vision. There's like a gigantic opportunity in doing this right. There's like, I think there's like $10 to $15 billion of like EBITDA across these like CFD brokers to be picked up. And it's actually like a very fragmented market, which is even better for like a newcomer. So, yeah.
All right. Well, that's it for today's episode. So for our audience, they want to find more about Ostium. Where would you refer them to?
So they can follow at Ostium Labs on X. They can follow me at Kaledora, just my first name, on X. You can also follow my co-founder at Contrarian Marco on X. And then you can also go to our website, ostium.com. We now have the .com domain. And then you can try the app if you have questions or you want to try the product. If you, are inspired by hopefully any of the vision articulated today, or the product sounds like we're solving a problem you've had, go to app.ostium.com or just go to ostium.com and click launch app and try the product. And if you have any questions or comments or feedback, you can always DM me personally on X. I'll respond. Or you can also obviously like raise a ticket or comment in Discord. You can find the Discord on ostium.com under community. So you can always join that Discord and, ask us any questions you have. We're always here and very hungry for product feedback.
All right. That's it then. Stay tuned for next episode, and thank you for joining us today.
Thank
Bye-bye.
you guys. Thanks for having me.
Thank you very much.